Today's housing starts data shows U.S. home builders broke ground on the fewest number of homes in almost a year and a half. Well, joining us now to talk about the data and its impact on the sector and the economy is Bob Moulton, president of Americana Mortgage Group. Bob joins us on set. Welcome.
Thank you.
The big news, or the surprising element of this morning's housing starts report, I think, is that they declined more than expected. What's your take on it, and what does it mean for the broader industry?
You know, unfortunately, I think it's the beginning of a trend. We saw a good growth in January. However, February was down, March was down, and April was down. We have been hearing about the real estate bubble from the media, and we have been talking about higher interest rates over the last 18 months. And I think it's a matter of the self-fulfilling prophecy, and I think that you're going to see this trend continue for the rest of the year.
So, right, this is a backward-looking report in the sense that it's the April housing starts number. We're in the middle of May now. So you're saying that this, well, how far out then would this last?
This could last through the third quarter of 2006. We're looking at firm housing prices. We're looking at a median house price up from last year. But if you look at April of last year, housing prices were continuing to increase through September, October of last year. However, when we look at housing prices now, we're looking at a leveling and we're looking at a cooling off. When you look at January and February, we're starting to see a little decrease in housing prices, and that'll probably, trickle into the end of the year as well.
When you say a little decrease in housing prices, what will the worst level be? How far will housing prices soften?
I don't think housing prices are going to fall off the cliff because we have a very strong jobs market and the economy is doing very well. But we have a very strong inventory. You have about twice as many houses for sale today than we did last year. So when you have an increased supply and you don't have the increase in demand, you probably see a decrease of about 5% in housing prices.
You're in the mortgage business. How does the slowdown translate to demand for mortgages?
Well, we're not seeing as many refinances as we have seen, say, in the boom of 2003. The Fed's increased rates 16 times since June of 2004. So we're seeing refinance activity where home equity lines of credit are going into fixed-rate mortgages. However, the number of transactions are less, probably about 20% less than where they were last year.
What are the most popular types of mortgages?
Interest-only mortgages are becoming more popular. 5-year ARMs are becoming more popular. When fixed rates were down around 5 and 5.25% back in July of 2003, fixed rates were very popular. However, now we're up 150 basis points. People are stretching to pay more for houses. They have higher energy costs. They have higher real estate taxes. So to get them into the home, they're looking at adjustable rate mortgages and interest-only mortgages right now.
I'm surprised people are still buying interest rate mortgages given this predicted slowdown and softening of prices.
Well, you can get a fixed interest-only mortgage for 10 years. And if you can get that at about 6.5%, it's going to save you about 25% per month versus a fixed-rate mortgage. So there's not much risk with that product. The products that are risky are 100% financing if there's a decrease in real estate prices.
So what about refinancings? Are you seeing more or less of those?
We're seeing less of those right now. However, some economists are calling for a 4.2% yield on the 10-year note. And right now we're at about 5.1%, down from 5.19. If we see 4.2%, we'll see a big refinance activity back into fixed-rate mortgages. Also, next year and the end of this year, you're having a lot of those adjustable rates that were taken out 3 years and 5 years ago that are coming to term. So that market should kick in also towards the end of the year.
So you're not selling any more fixed-rate mortgages?
Few and far between.
I think that's interesting. Okay. I want to ask you about bridge loans, too, as more homes are staying on the market longer. Are you seeing an increase in those types of mortgages?
Well, right now we're in a buyer's market. Last year we were in a seller's market. When we were in a seller's market, people would buy first and sell first and then buy. Now people are selling first and then buying. However, if they do buy first and they cannot sell their home, there's a big demand for bridge loans, and those are becoming quite popular.
And are they using them for any other purposes?
Sometimes for home improvements they can use them, but primarily to bridge the difference between the equity that they have in their existing home to buy that new home. And that's where we're seeing the use of bridge loans right now.
Do you sell your mortgages to other institutions? I'm
a registered mortgage broker, and we close in the name of third-party lenders. So we represent over 100 lenders, and we always close in the name of local, regional, or reputable financial institution.
As far as you know, that passed along, is the profit margin diminishing any?
As rates go up, the profit margins do decrease, so we do need to watch our expenses a lot closer than you did when we had the refinance boom 3 years ago.
Gotcha. Okay. Bob Moulton is the president of Americana Mortgage Group.
Thank you very much.
Nice to see you again. Thanks for coming back on After the Bell.